Why do most emerging market currencies peg to the US dollar, even when their governments politically hate the United States? Saudi Arabia, the UAE, Hong Kong, Lebanon, Argentina, on and off. None of these is a US ally in any sentimental sense. All of them peg their currency to the dollar. Why? There are roughly 65 currencies in the world that maintain a hard or soft peg to the US dollar. The Hong Kong dollar trades within a tight band of 775 to 785. The Saudi riyal has been at 375 since 1986. The UAE dirham at 3.6725 since 1997. Lebanon collapsed its peg in 2023 after holding it for 24 years. The trade is simple. A peg imports the credibility of the anchor currency. The local central bank gives up independent monetary policy in exchange for stable expectations, lower inflation, and cheaper foreign borrowing. For commodity exporters whose revenue is denominated in dollars, oil, gas, copper, cocoa, pegging removes a major source of revenue volatility. But the trade has a structural cost. The local central bank cannot run an independent monetary policy. When the Federal Reserve raises rates, the pegged central bank must raise too, even if its domestic economy is slowing. This is the impossible trinity in plain English. You can have free capital flows, a fixed exchange rate, and independent monetary policy, but you can only pick two. The geopolitics is real, but it does not break the math. Saudi Arabia genuinely diverges from US foreign policy on multiple files. It still pegs to the dollar because its oil revenue is in dollars. Its sovereign wealth fund is largely in dollar assets. And the alternative, pegging to a basket, to the yuan, or floating, is technically harder and politically riskier than the current grumble. Until that calculus changes, the peg holds. For the operator, any business operating across a pegged currency zone needs to model peg break scenarios. Lebanon went from £1,500 to over £100,000 per dollar in 18 months, once the peg broke. The contract clauses that protect you are the ones you write before the break, not after.